All right, let's talk about HELOCs, home equity line of credit. We're going to talk about the pros and cons, what it is, the best usage, where to get it, and how to get it. So stick around. This is the Kwak Brothers podcast show. Hey, what's going on, guys? This is Sam Kwak, one of the Kwak Brothers, and welcome back to the podcast episode 41. In this episode, we're going to talk about home equity line of credit, which has been really popular in the last couple of years with different introductions to strategies such as debt acceleration, velocity banking. You may have seen other videos on replacing mortgages and such forth. So I'm going to explain to you guys, for those who are brand new or even those who have heard about it, what the differences are with home equity line of credit versus some of the other loan products out there. Now, you guys may have seen my video on how to pay off your mortgage in 5 to 7 years, and it's got more than millions of views, so I appreciate you guys, and I thank you so much for the viewership and support. So if you guys want to see the best usage, the strategy behind HELOC, I did go ahead and include that link down below in the link description, so go check it out. It's about 20-30 minutes long. And then if you guys want to see the rest of this video and get the video at the end, I'll go ahead and attach that to the end video screen. So definitely check that out. So for those who are brand new or not familiar with what HELOCs are, HELOC stands for Home Equity Line of Credit. Now, as the name suggests, it's a line of credit that's attached to home equity. Now, equity is obviously the difference between what the property is worth minus what you owe to the bank. So I'm going to get really elementary here. I know some of you guys know this, but I want to make sure that we're breaking down this for the least sophisticated people watching this video. So let's say you have a home that's worth $100,000. And I'm using $100,000 more as a general, easy to use kind of number. And let's say you owe $60,000 to the bank. Okay, that's what you owe. So that difference, $40,000, is the equity that you have on the property. So basically, the home equity line of credit, it's giving you a line of credit, which is kind of like a credit card, on that $40,000. Now, this really depends on the bank, the institution that is giving you the home equity line of credit. Generally, assuming that this is a 100% loan-to-value home equity line of credit, you're going to be able to utilize $40,000 of that equity as your limit to spend and to pay back, to repay, and whatever you utilize, just like credit cards, are going to be subject to interest. Now, here are some major differences between home equity line of credit versus your mortgage or traditionally a term loan. A term loan is usually set with a payment period. It's amortized, meaning it could be paid back within a 15-year period or a 30-year period. And you typically are going to get the money up front, right? When you buy a property, you can get that money at the closing. It's going to pay for the property and differences to the down payment. So that's traditionally what home equity loans or traditional mortgages do. Now, with home equity line of credit, on the contrary, work more like what I've just mentioned, like credit card. So with the $40,000 equity for this example, you're going to be able to spend up to $40,000, and if you do choose to use up to $40,000, that $40,000 is going to be subject to interest, and you get to pay back, right, just like a credit card, and use whatever portion of that $40,000 back to whatever spending that you want to spend. Now, another thing that's unique about HELOCs and home equity line of credit is that it varies from banks to banks and institutions to institutions. So unlike mortgages, where it's heavily regulated by the federal government and the governing bodies, HELOCs are banking products. So depending on which banks you go, you're going to see different rules and terms, different interest rates. You may see different promotional offers. So that's something that's unique about HELOC. So one thing for sure, and here's a tip that I can share, is that if you're looking to get a HELOC, do some shopping, right? Not all lenders and institutions are going to be the same. So make sure you do some comparing. Make sure you go and shop and figure out which bank and institution is going to be the best fit for you for whatever you're trying to achieve. Now, obviously, if you're wanting to do the debt acceleration strategy, I talk about some of the things that you should be looking for from a bank. So go and check out that video once again if you're looking for that answer. But generally, you want to look for a bank or an institution that's going to allow you to get a HELOC. Whatever your goals are, you want to make sure you align with that goal. So a couple things as far as pros and cons. The pro is that, again, it goes back to flexibility. You can use it, pay it back, use it again, pay it back. It's that flexibility that allows you to kind of control and manage your cash flow. Now the con is that typically the interest rate is higher than your traditional term loan, and it tends to be adjustable interest rate. So right now, what we're looking at, 2018, for those who are watching this as soon as this is uploaded, we're about to see another interest rate hike. So getting a HELOC now may mean that you may have to pay a little bit more interest when the interest rate goes up. So HELOCs are based on the interest rate goes up or down based on the index, typically the prime index. And going back to shopping for the right institution of banks, I'll tell you what, not all banks and institutions will charge you the same interest rate. Different banks have different margin, right? So that's the interest rate that they charge you on top of the prime rate for them to make money, for banks to make money. So do some shopping too with interest rates, because just because it's adjustable, just because there's an index, right, doesn't mean that not all interest rates are going to be the same with home equity line of credit. So do some shopping on that. Now, I know I'm going to mention this a lot, and that's my disclaimer. If you're using debt acceleration strategy to pay off your mortgage using HELOCs, I'll explain why the adjustable rate and the higher interest rate won't really matter. It really depends on how you use the tool for your goals. But generally, when you're looking at the overall picture, the adjustable rate and the higher interest rate is viewed as a con versus, obviously a pro. Another pro is that home equity line of credit tends to be you have different loan to value ratio. So traditionally with mortgages, you're gonna be around 75 to 80% loan to value. With home equity line of credit, I've seen certain HELOCs up to 100% loan to value, meaning 100% of the property value is going to be covered in the HELOC. Now, the con with that, obviously, is that with 100% LTV, you're going to be over leveraged, meaning you're going to have too much debt where it becomes kind of, personally, it becomes a little dangerous. So if you strip all the equity, meaning you take all the equity out and use that as a HELOC, there might be some dangers if you aren't quite disciplined or you don't have a functioning budget to control yourself from overspending. So that's one danger that I would kind of warn you guys against for those who are frivolous spenders, which I know most of you guys aren't, but I want to make sure that you guys aren't using the HELOC for abuse. There's better ways to do that. Now, with HELOCs, again, I explained to you guys that it's not amortized, it's on line of credit. So meaning, line of credit, just like credit cards, the way that interest is going to be applied is going to be applied through average daily balance or average daily interest. Now, I can do the math for you guys in a pretty simple term, and this is generally how average daily balance or average daily interest works. Now, if you guys actually take a look at your credit card statements or the disclaimer that you got from opening your credit card, right? So when you first open your credit card, you got all the packets and paperwork, right, with all this small lettering. If you actually take a look, they'll actually tell you how simple interest works. In fact, I believe banks are required to disclose that to make sure that you understand how you're going to get charged for your interest. Now, as far as line of credit, whether it's business line of credit, personal line of credit, HELOC, credit cards, simple interest works. Balance. Totally spelled balance wrong. I started with BL. There you go. Balance. Right? So whatever balance you have on your home equity line of credit. So in this case, if you have $40,000 of limit of equity line of credit, let's say you used $10,000. Right? So $10,000 is going to be your balance. Divided by, 360 days times the interest rate. Okay? And that is your daily interest. So what's unique about that, and why I want to highlight that, and sorry I'm bunching everything up. The reason why I want to highlight that is this is the main difference between the mortgage. Now, with the mortgage, if you make a mortgage payment, you're kind of stuck, right? Once you pay, you're not going to get that money back, right? You pay the interest and principal, you're stuck giving that money away. With a HELOC, you can pay it back, right? Use it again, pay it back. So the reason why this is so important, I want to highlight this, is because let's say you use $10,000 and then tomorrow you use another $1,000, but you paid back $5,000, and then you use another $6,000, right? So you're gonna see a varying interest for whenever you spend that money. So day one you may have $10,000. So I'm gonna try to be clear as possible. I know this may get confusing pretty quick. You may have a $10,000 balance, right? On day one, that means you have X amount of interest, but tomorrow you spend another $1,000, right? Because it works like a credit card. Now you have $11,000 balance. So day two, you're gonna have a different daily interest. But on day three, let's say you pay it off by $5,000, so you're back down to $6,000 of balance. So $6,000 is gonna also reflect a different daily interest, wouldn't it? Right? So that's something that's unique. And this is where and why, and the fundamental basis as to why the debt acceleration strategy works is because of this math and this uniqueness to be able to pay back the HELOC, use it again, pay it back, right? Use it again. So that's what's unique about, and that's why I love HELOCs, is because of that flexibility. So I hope that I give you guys a pretty good definition of what HELOCs, what they can do, some of the pros and cons, where to get it. Now, as far as how to get it, obviously banks will do the same thing as if you were to get a mortgage. They'll check your credit. They'll look at your debt to income ratio. They'll make sure that you're financially sound so that you can pay for it. Obviously, the banks don't want to give you a loan if you can't pay for it and your credit's in the dumps. So you have to have a decent credit. Now, depends on which banks you go to. They're going to have different and varying factors they'll look at. But generally speaking, they're going to look at your FICO score, and they're going to look at your debt to income ratio, the income. They're going to want to have you turn in your tax returns to verify your income, right? So that's all going to be a factor in getting a HELOC. So if you can't qualify for a mortgage, I hate to throw this in the same bucket, but it's going to be a challenge for you to get a HELOC if you can't get qualified for a mortgage. Now, again, depending on where you go, different lenders have different guidelines and practices and factors as to what they judge and what they look for. So do your research, find the institutions that want to work with you if you're looking to get a HELOC. So guys, I hope that explanation got you closer to understanding what HELOC is, how it works, pros and cons, how to get it, where to get it. And if you guys have any questions, go ahead and leave them down below and ask me a question. We're pretty good about answering questions on YouTube, and we typically try to get you the answer within 24 to 48 hours. And if you don't know the answer, we'll get you somebody who does know the answer. Now, if you guys want to check out the debt acceleration strategy on how to use home equity line of credit to pay off your mortgage, or in fact student loans and car loans, I'll have that video in the link description box below, so go ahead and check that out, click on it and watch it, or stick around to the end and I'll include the video on the end screen, so all you have to do is just click on it and it'll take you right to the video so you can enjoy it. So guys, that's it for me. I'll see you guys in the next episode. Stick around and I'll be more than happy to help you with whatever goals that you have.
Well, hello there. You made it to the end of this video. Congratulations, and that probably means that you like our video and you love what we did. So be sure, if you want to get more information, more YouTube videos from us about real estate investing, be sure to subscribe to our YouTube channel and hit the bell icon to make sure that you get notifications on our future videos about real estate investing.